All right, hello and welcome, guys, to another All About Markets Spaces session with me, Yash Upadhyay from the Stockbits India team, and Ashwin from Business Insider India.
Hi,
Our
Yash.
guest
Hello.
this
How
evening
you doing?
is
Hi, Upadhyay.
Basant Maheshwari. He's the co-founder and partner at Basant Maheshwari Wealth Advisors LLP. I know a lot of you guys have already seen Basant at a lot of business news channels or have heard him over a long period of time. But just to give you guys a quick intro, Basant has been in the markets for more than 3 decades. He has a solid track record of identifying some of the biggest multi-baggers in this huge career, including Page Industries, Titan, Bajaj Finance, Avenue Supermars. He also is an author, by the way. His book, The Thoughtful Investor, A Journey to Financial Freedom Through Stock Market Investing, is something that we're going to discuss. And it's almost 7 years since he started his own PMS firm, Basant Maheshwari Wealth Advisors. So, congratulations, Basant, for that. And thank you so much for agreeing to do this.
Fine. Thank you so much for having me. So we can start.
Awesome. Basant, quickly just wanted to get your thoughts in on the recent inflation data. The domestic CPI came in at almost a 3 month high. US inflation also continues to be on the higher side. Does this spell trouble for equities?
I mean, our trouble for equities based on our data is still we don't get another data from the US. We are pretty much interlinked. And the reason why we have held up is because the US markets have held up in spite of all the happenings that are happening in our corporate arena. So I think our data looks very good for 2 hours, 3 hours, 6 hours, 12 hours, and then after 24 hours, we forget it and move on. So that's the unfortunate reality right now.
Awesome. Ashwin?
Yeah, Basant, while Yash talks about all things Bajar, I
Yeah.
want to talk to you about your book, The Thoughtful Investor. You have a chapter on the macro numbers and how much to analyze. And given the current
Correct.
market scenario, talk to us some of the key numbers that are on your radar as you're, analyzing the markets.
So if I have to do a Twitter Spaces with you, I will have to talk macro. If I have to do a YouTube video, I will have to talk macro. But if I have to buy a stock and hold it, the macro doesn't help because if you have a 2 year view, if you have a 1 year view, if you have a 3 year view, the macros even out each other. So it's all a statistical reference. 1 year inflation will be high, the other year it is supposed to be low because inflation is never measured as a 5 year CAGR. It is always measured as a year to year comparison, which I keep on talking about all the time. But the world believes in macro. So what happens is, even though you think it's of no
Uh-huh.
use, if your neighbor is thinking about macro and selling his stock down, then the stock will come down. So you might say it doesn't matter, but the stocks do fall 75% because somebody else believes in something which he should not believe. So we paid the hard price last year by thinking that macro se kya hota hai doesn't matter. But macros matter for your stock price in the short term. But in the long term, it doesn't matter. In the long term, there's just one thing which matters. That's the earnings of the stocks that you own.
Right. Thank you for that very candid perspective, Yash.
Basant, we'll talk about Adani a bit more in detail, but just wanted your thoughts that, despite the whole Adani Hindenburg drama, we had the budget, the US FOMC outcome, and, the whole return of FII selling. Our markets are still just down about 5% from all time highs. Now, do you see this as a positive that markets are holding up? Or is this, to put it plainly, pure play index management and eventually the bulls will throw in the towel?
No, I think the markets are holding up because the US markets have been quite resilient.
Okay.
If you would have a situation where the Dow and the Nasdaq were to fall 5% each, we would have gone down 10%. Adani is no small thing. It's a huge thing. It's got major ramifications and repercussions, which we don't know. They might happen, they might not happen. I'm not in a position to actually prove something or share evidence. But the fear with every market participant is what happens when the entire Pandora box opens up, and we don't know that. So I think we've held ourselves not because we are a terrific thing and a brilliant economy, but we have held ourselves because the US markets are going up and they are recovering. So the far reaching stocks in US, companies with 5 year, 7 year, 10 year profits, companies that were making losses in US, they have recovered quite a bit. So it tells you that interest rates, higher interest rates will soon be a thing of the past, and recession or no recession, I think we have discounted everything. But I think the bigger problem here right now is if the US were to fall, then I think we will fall harder. Just because the US is going up, we are holding ourselves back. Or we are holding ourselves up.
Okay, so the decoupling story is over, according to you, Basant.
There was never this story. I think I spent the entire 2008 thinking that there's a decoupling, but there's no decoupling. I mean, how can a $2.5 trillion economy decouple from a $25 trillion economy? So it's all good and patriotic to say that we are decoupled and India's time has come, but India's time will come when we are really self-reliant. But we are not self-reliant in that sense because whatever the FIIs are selling, the domestic guys are buying, and we're just there or rather drifting quietly. But if you see after what has happened after the Adani saga, the small and mid caps have been butchered. So they are all down 20, 10, 20, 30%. The large caps are holding up for whatever reason. So it's not that the markets haven't come down, the small and mid caps have come down a lot.
Got it. Ashwin, over to you.
Thanks, Yash. Basant, trend spotting is one more thing that's, fairly prominent in your book. And given all the things that Yash was speaking about, the Adani, the budget, the US FOMC outcomes, what are some of the larger emerging trends and themes that are on your radar and something that you think other investors should, keep an eye out for?
So, from an Indian perspective, I think the biggest trend right now and the safest trend and the longest trend is the consumerism because with $2,000 per capita, that's just one way to go. But the results that these consumer companies are showing are appalling. If you see, I mean, a company like Asian Paints and Bata is showing negative volume growth. Hosiery companies are showing negative volume growth. So who would have thought that people wouldn't be buying innerwear? So you can say that there's channel inventory destocking company like Page Industries, which sells the Jockey brand of innerwear, I think showed a 2% revenue growth, which meant that the volume growth was negative. So it tells you that the consumer is completely on the back foot. He's hit by inflation. And I don't know where are we getting the 7.5% GDP numbers from. So that's really striking for me. But if you have a long term view, everything tends to balance each other. And if you're trying to play it from India, I think consumers and financials are the way to go. Unless you are a small cap stock picker, then you can find your own niche. But globally, there are trends that the trends are in technology, but in India, and I think the big trend in India, the safer trend in India right now will be the IT offshoring companies. Because once US recovers, you will have a lot of work for these IT offshoring companies, and they've been battered black and blue. But the results were good. Most of them have beaten the guidance, and a few have also upped them. So I think IT services should come back to the fore.
Basant, one quick question. What is long term in your perspective? My father's idea of long term and my cousin who got his first job, their idea of long term is very, very different. How do you look at long term? What's the time period?
So I can start with the first proponent of long term, that was Lord Keynes. He said, in the long term, we are all dead.
We're all dead.
So if you ask me, my perspective of a long term is till you don't make enough money. But on a serious note, long term means at least 3 years. It doesn't mean 1 year. Because in 1 year, I mean, we'd like to think that long term is 1 year, but we've spent the last 1 year struggling. So you don't struggle in the long term. In the long term, you end up making money. So if you're struggling in the long term, it means it's not a long term. So 1 year is not a long term. Long term is 3 years because the last 1 year we've been struggling. So that's a definition I've just picked out while speaking to you.
Thanks for that.
I'm just curious, Batan, what if someone's losing money even in the long term? Then how long term is it supposed to be?
They really need to rethink their portfolio.
No, but I think on a very serious note, the days where you would have said that buy this stock and it's going to do well for 1 year or 2 years, they're gone because there's so many variables. There are so many random things that affect the stock these days. It's very difficult to capture them out, and you have to even out an economic process. So if the economy is slowing down, you have to even it out, and the slowing economy doesn't recover back in 12 months. So a long term cannot be 12 months because by a strict definition, my definition or anyone's definition, you would say a long term would be a period where you shouldn't end up losing money. So if you're losing money in 1 year, then 1 year isn't a long term.
Got it. Okay. Nice. That's a nice way of looking at it.
Yeah. Basant, I alluded to the Adani Group bit at the beginning. It's been at the center of all that is happening in the markets. Again, yesterday they released
Yeah.
another presentation in a bit to, assure investors that they're financially sound. What do you think about this whole episode? Without going too much into the allegations in the report and the too many nitty gritties, but do any of these stocks make for an investment case at current level?
Not at all. Not at all. Even if they are down 90% from where they are, you shouldn't be touching them because you don't know
Mm.
what's in there. Nothing's come out. Who is to say whether all of these companies are good, bad, or ugly? So we don't know. So I'm not saying that there's something wrong there. What I'm saying is, I, as an individual investor, wouldn't like to buy them because there's so much of cloud surrounding them that I don't want to. Why would you want to put your hand into a dark hole and you don't know whether there's a snake still sitting inside? So I wouldn't like to do anything of that because the situation is very difficult. And Adani was the poster boy. If you would have seen my videos on
Mm.
YouTube, I've already said that the poster boy of any bull market normally falls a lot more than people think it should fall. So maybe 80, 90%. So some of these stocks are already down 80%. Adani Green, I don't know if somebody can calculate and tell me, they're already down 80%. Transmission also is down 80%. So that's normal for poster
Yeah,
boys
I think
to fall
I think
80%.
they're
Then
just
50,
locked in a
60% is
five
okay.
percent lower circuit every single day. Yeah.
I think it's like putting a patient on a ventilator, putting it on a 5% circuit. I mean, they should just remove the circuit and let the market find its own value and start trading at whatever price they want to.
Right.
Got it. So
Basant,
nothing to
the
comment
moment
more on the companies or fundamentals, but not the right
Yeah.
time to buy them. That's the conclusion, right?
No. You might think, I might think, all of us would think that Adani Port is great value, Ambuja Cement is great value, but it's great value if somebody can assure me and ensure that there is nothing else to it than what I can see in the balance sheet. So that
Mm.
is my fear, and I don't want to get involved into all these stocks because there is so much of talk happening. And I mean, who am I and who is anyone else to say whether Hindenburg is right or wrong or whether they are fair or unfair? So there are so many stocks to choose from, hundreds of them. So we'd better go and look for something else. But I know what's happening right now. People are lapping it up, saying Wilmer has got a foreign parent. They would say port is a hard asset. They would say Ambuja is still a cement plant, so we can look at that. They would say the same
Mm.
thing about Adani Enterprises, that the airports are there. But for my money, I wouldn't buy them at this price. I wouldn't buy them if they double up. I wouldn't buy them even if they fall 50% from here. I would just avoid them rather. Not say I would not buy them, but I would avoid them.
Got it. As Rakesh Junjunwala would say,
right.
I don't need to be at every single party in the city. Ashwin, over to you.
Yeah.
But I'm going to stay on this trend for a little longer, and as you said, right, there's a lot of in a sense, there's a lot of concern around this script, and people are de-risking themselves from this issue. Talk to us about some of the small and mid caps that you find interesting, and you think other investors should take a closer look at.
No, I think if you're looking at small and mid caps, you should be first prepared to lose 10-20% immediately because if there's a turmoil, if the Adani stocks don't stabilize, then small and mid caps bear the brunt because institutions don't buy them and the
Hmm.
retail normally panics very quickly.
Hmm.
So stocks where institutions don't buy and which has got a larger retail holding normally fall more because there's no one to support them in bad times. And retail normally sells on news. They don't buy. They might all be saying that they are long-term investors, but generally, whenever they see bad news, they want to go out and sell out. And that is the reason why I would say that small and mid caps would make money selectively, but if you buy them, you should be prepared to lose some money on the table because if the issue doesn't solve itself quickly, then there'll be a struggle for a few more weeks. But the bottom line is whatever has to happen with these set of stocks should happen very quickly. If they stabilize at whatever level, then the markets can recover and move back where it wants to go to. But till the time you have 4 or 5 Adani stocks hitting down circuits every day, the
Hmm.
entire the other part of the market cannot be normal and safe. That's my problem.
Right. And just bringing the attention back to your book, right, in the sense that there's one chapter, where you're talking about should a small investor always stick to small cap? And in that vein, what are some of the good questions that investors should ask when, a small investor wants to really expand their portfolio and move away from small and, then they start looking at mid and large caps?
No, the first question that you should look for while you're buying mid and large cap is what is the growth rate of the company, because markets normally pay for growth. So if you're buying a large cap just for the sake that it looks good on your portfolio, it's of no use. You could go and buy Nestle, but Nestle would find it hard to grow at even 14% annualized. That too in a country where you have 7% inflation and presumably 7% GDP growth. So
Hmm.
14% nominal growth. You would normally go and buy a mid and a large cap only when you would want to get at least 20-25% CAGR on those kind of companies, because markets ultimately pay for growth, or you're buying an undervalued company where you think that the market would over the next 2 3 4 years stand up and revalue it to some level. So when you're buying undervalued companies, you would need to think that there should be a catalyst which should actually push the market to revalue the company to the current level. So most of the times we end up buying an undervalued company which remains undervalued for long periods of time. Without a catalyst, an undervalued company doesn't make money for its shareholders. So that's the first question to ask if you're buying an undervalued company. If you're buying a growth company, then you need to look at the valuation at which you are buying. So there are companies in India which are growing at 20% and which have a PE multiple of 80. So 80 PE and 20% growth is totally unacceptable. You might get stuck into those companies for 3 4 5 years without making any return. So that's the fear.
Got it. Thank you for that, Vasant. Yash?
Basant, insurance stocks have been taking a lot of beating after some not so favorable, proposals were announced in the budget. We know they've been, ranked underperformers, trading even below their pre-COVID levels. What is your high-level take on the whole space?
I mean, see, in our market, especially in global markets, not just Indian markets, whatever has to happen happens very quickly. So in about 2 3 days, you adjust for everything. So if I tell you that some promoter of a company has died, the stock wouldn't keep falling for 20 days unless there is a 5% circuit. So if the stocks are free, then price adjusts itself very quickly. So I think the insurance stocks, they've adjusted to everything right now, and they've adjusted to everything without the price falling more than 10 15%. So you could buy them, but they're not cheap. They're very, very expensive. If you look at HDFC Insurance, no recommendations for any of the stocks that we're talking about here. None of them are cheap. They're all very expensive. So, I mean, if you want to have a 10-year view and say, I'm okay not making money for 2 3 years, you can start buying them. But then
Hmm.
I don't know. I'd rather go and buy the private banks than the insurance companies, if you ask me.
All right. Um, Basant, you spoke about how FMCG companies they are having a hard time. We spoke about the volume growth of some of these companies, but on the other hand, automakers they are still selling record number of cars. So, what do you make of this dichotomy, and how do you approach the whole consumption basket?
See, auto companies in India will realize after 1 or 2 3 years that they've just fallen by the wayside. So our premier auto company is a Maruti, which has got a Suzuki as a parent from Japan. And Maruti and Suzuki both are holding hands, thinking that someday Toyota will find something spectacular in the EV world and do something for them. And I think this is going to hit them really hard because the world is moving to electric vehicles. And Tata Motors has actually done something in the EV space, but not good enough, because in the EV, it's becoming like a winner's take all. So I think for an investor who doesn't know what's happening globally, you would say that auto is a good sector to bet on. But if you have some knowledge and if you have some awareness of what's happening globally, I would say many of the auto companies, many of the ICE auto companies, I mean the ones which use gas,
Hmm.
would kind of, I wouldn't like to use the word say close down, but I would say they would pretty much come about to a situation where survival would become challenging for them.
Got it. Ashwin,
Thanks, Yash.
You're on mute.
Vasant, beyond being a wealth advisor, you're also check 1 2 3 1 2 3. Am I
Yeah.
audible? Yash, could you give
Yes,
me a
yes,
quick
we
answer?
can hear you.
Yeah,
We can
cool.
hear you.
Basant, you've been in the markets for for the last 3 odd decades, and more than a wealth advisor, you're also an observer. How different do you think are new age younger investors as compared to first time investors maybe 30, 40 years back?
So tremendously intellectually advanced, today's investor. But what they lack in is experience. So they'll hear a news, they will sell, they will see a news, and they will buy. So because they think that whatever is hitting the headline today is going to decide the future of the stock for the next 5 years. And that's the problem because they don't have experience, they have only information, and they're intellectually quite advanced. And you can acquire intelligence, you can have that intellect, but where do you get the experience from? So I think that's the problem with most of these investors. And my only suggestion to them would be to go and read a lot of books, go and read at least 50 to 100 books from of people who made it big in this world. And once you read a book, you just get to know that what hits you on the newspaper headline today isn't as relevant as you think it's supposed to be, because this is all old news. Somebody's already taken a position based on when this news was actually coming up. So that's the only difference. But intellectually, today's investor is much more smarter, sharper, and much more intellectually advanced than what we were when we started. We had just no clue. We were just betting on prices. But today's person, today's investor knows everything. So that's the only gap.
So how does social media and Telegram information channels complicate the investing game?
See, first thing, if you land yourself on YouTube, there are 200 channels to choose from. And even if you think that one video is 7 minutes or 8 minutes, there's not enough time. Who prioritizes what you're supposed to see? If 200 people are looking at a video based on the headline, then obviously it could be a waste of time also. So that's a problem. That you're spending too much time reading and thinking of what's happening today without trying to figure out whether you should actually be listening to all those blogs and vlogs and all of those things. And Telegram, and the shorter the messaging system, the greater the chances of a problem. So Telegram, I think, uh, it's actually a Telegram what we used to have about 30 years back. So how do you make an investing decision based on a Telegram? So I think that's the problem. It's better that uh, an investor would rather not go there and read a book, maybe spend 2 hours a day reading, but that's what no one would do. And that's what even I wouldn't encourage because I've got a YouTube channel, so I want all those hits and all those views. But but if you ask me genuinely, a person should read at least 20 books before he thinks that he should be on Telegram and Twitter and YouTube and trying to decipher, because that will help him figure out what is relevant for him. Because unless he's read a lot of books, he wouldn't be able to figure out what's relevant for him. So there are YouTubers who would, and people on Telegram and people on Twitter also. Why just YouTubers who would have all their money in fixed deposits and real estate and tell you how stocks are a great way to build cash and build wealth. So how do you figure that out? Whether that guy has actually put money into stocks or he is just enticing you with all the fancy stories so that you can add a few more views to his videos. So that's a problem.
So this is essentially a signal versus noise issue. So Basant, what are the
Yeah.
good signals that you would recommend? If you had to give a pick of, let's say, 5 news sources that you consume on an everyday basis to help you make your decision, or maybe a couple of books that you are reading right now, point us in that direction, please.
See, if you have a long term view, you don't need a
Hmm.
signal every day.
Okay.
If you have a long term view, the signal is just for you to tell your mind that you're doing enough. So, I mean, when I used to have Page Industries, on most weekends or most weekdays, I would just walk over to a nearest store and just to go and see there whether the goods are going off the shelf or not. So, but that's not relevant. That's not important. We're just doing that to tell ourselves that we're working hard for it. So sometimes, if you before a math exam, even if you have solved 3 reference books, you still want to go through the old problems that you have solved because you can't tell yourself that I have an exam tomorrow. How can I go and watch TV? So we try and do all of that. But mostly, if you have a long term view, everything will align itself. All those geometry, all those chart building, and all those chart formations, and it's broken 200-day moving average and weekly toot, yeah, and RS is up and RS is down. I mean, for all my years, I knew that RS meant Rajya Sabha, but then once you come on Twitter, then you figure out these things. And these are the perfect places where you're going to sell a stock when you should be buying them and buy a stock when you should be selling them. So that's the problem.
Right. Thank you for that. Yash, over to you.
Awesome, Vasan. That maths thing really hit me because it's super relatable. I did that when I was in school. Coming back to the market discussion, Vasan, I know a lot of people are super bullish on the whole infrastructure and manufacturing theme, but it is a huge space to navigate. There's also the capital good companies. How does one go about identifying the
Sir, your
winners and losers?
largest sir, see, the problem is
Hmm.
infrastructure is mostly a low ROE, high gestation, low cash flow business.
Hmm.
That's what exactly doesn't make you a lot of money. So it might. So normally they say, like, when you're digging for gold, you should better be selling pickaxe and shovel. So if you think that infrastructure would do well, you'd rather go and buy companies that sell infrastructure products to these kind of companies rather than buy the developers themselves, because
Hmm.
most of these companies have long gestation periods. So if you're building a road, first is it's an L1 thing. So the lowest bidder in a tender wins it. A lowest bidder means that he's not making supernormal profits because there are 200 people competing with him to win the contract. So in the long run, infrastructure companies don't make a lot of money. And that's exactly the problem which we see normally, because most of the big belly up guys that happen are from the infrastructure space. In 2003 to 2008, I don't know if you were in the market at that time, there were a host of infra companies:
Hmm.
HCC, Nagarjuna Construction,
Yeah.
IVRCL, you name it, and they were there. Where are they now? They're all down 90, 95, 99%, and some of them have even been delisted. So it's great if you want to do a 1, 2, 3 year punt, but for the long run, it wouldn't help.
Got it. Basant, you've been in the markets for so long, and there is definitely no substitute to hard work. But if you had to pick one and only one thing that you knew when you started investing, what would it be and why?
One thing I just stuck on. Even I was losing for the first 8, 9 years. I would get cash and I would put it into the market. But I had the belief that, like they say in Hindi, paisa banega to yahin se banega, which means that if you have to make money, you have to make money from the stock market only. There's no other way where you can get rich, filthy rich. I mean, other ways you can buy a car on down payment and keep paying EMI for the next 48 months. But if you want to write a check and get a car home, it's the stock market that helps you do that. If you want to write a check and buy a home without going into the EMI, it's the stock market that helps you do that. So that was the belief within me. And secondly, and most importantly, I think it was in reading. So I would have read too many books, and more importantly than reading, it was about knowing what not to buy. So
Hmm.
2003 to 2008 was a huge infra rush. It was a huge telecom rush where infra companies and telecom companies went up 10, 20, 30, 40, 50 times because there was a global liquidity thing, and the BRIC thing had emerged at that time. BRIC being Brazil, Russia, India, and China. So out of the BRIC, the B and the R had been displaced, and India and China remain right now. So, but that's the thing. Now you don't have to buy real estate. You don't have to buy infrastructure. But knowing not what to do, that is what Charlie Munger says, is very important than knowing what to do.
Got it. Basant, me and another one of our listeners, he also has the same question: is that what are some of the most important fundamental parameters that you should look before going and investing in a stock?
So, I mean, you could buy 100 PE stock and still make money. So, valuation is not the most important. The most important is whether the company that you have bought is going to survive and be, and whether it's a leader in its pack. So, if it's a leader in its pack and if the industry survives, you will make money no matter how highly valued the stock is. And I'm saying this with some sense because even if you buy a stock at 100 P and
Hmm.
the company survives and is a leader in its space, you will still end up making money. But you buy a stock at 10 P and the company goes belly up and the sector just disintegrates, then you
Hmm.
won't end up making money. So that's the difference. So you have to buy a leader, you have to buy a company that is a leader and intends to remain a leader. It should be a low cost company, a low cost manufacturer, or maybe a brand. Like Warren Buffett says, it could be a moat or whatever. But
Hmm.
those are the three very basic things that you have to look for. But people end up buying the cheapest stock. That's the problem.
Got it. And do any of these new age companies happen to check the boxes? Say For example, Zomato, it is sort of,
See,
the number one,
no, no,
number two
no.
place.
If you have to buy the no, 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 no. If you have to buy the new age companies, you have to travel westwards and go Nasdaq. That's the way. So I could tell you,
Yeah.
you could buy Meituan. I think I did a comparison on Meituan and Zomato
Hmm.
some time back. So I mean, in a two-player market where both players are losing money, it's not a great situation to be in. If there's one player who's losing money, then at least he's gaining market share by losing money. If you're losing money and you're not gaining market share, why are you losing money in the first place? It's just a two-line commentary. You should ask yourself, or the investors should ask themselves, what are they gaining by losing money if they're not getting market share? It's supposed to be a
Mhm.
capitalist economy. You're supposed to be gaining something by losing money. You can't be losing money and not gaining anything. So, and now that's the problem because investors don't realize that unlike other countries, India is a two-player market. You've got a Zomato, you've got a Swiggy. And the moment you find that either of these are making money, suddenly you'll find Reliance Jio also delivering food to your doorstep. So that's a problem. And plus, you're not doing anything with the data that you're collecting. You can use the data for doing too many things, but they're not doing anything because they're losing money in the primary business. So people say that EBITDA would be flat or whatever. But if you ask me, I would rather gain market share than I'm losing money. But if I'm losing money and I'm not gaining market share, there's no point losing money.
Got
Got
it.
it.
And we have some time for some questions. So if anybody of you would like us to bubble up either a question or a thought that you have up to Basant, please reply to this tweet, and we'll bring it up. Avoid asking script-specific questions, and perhaps more a sector-specific one would be advantageous to a lot more people. Yash?
Basant, while you were answering the previous question, one more gentleman by
Yeah.
the name Nitish wanted to know your view on whether he can hold DMart and for the long term. And by long term, he meant like DMart
For
for 20 years?
20,
Question mark.
Till it,
20 years.
20 years. I mean, how old is he?
I don't know.
See,
Don't know that.
it's great. No, no, it's great to say that you want to hold a stock for 20 years, but when the Nifty will go up 1,000 points and your stock wouldn't move 20 rupees, you would say, "यार क्या खरीद लिया मैंने?" So see, DMart, nobody wanted to buy it at 600 when we were lapping it up. At that time, people said it's expensive, and I see the number of questions that hit me these days on DMart tells me a story. So this might be another program for another day. But if you tell me these popular stocks, because when a stock is hit 6,000, it comes to 3,500 and doesn't go back to 6,000 very quickly. It seems very good to own and buy. So DMart will possibly give you 12, 13, 14% CAGR for the next 20 years. I would say that. No recommendations. You can do your own research. But you're not in the stock market to make 12, 13, 14%. That's my
Uh,
thinking.
Basant, Nitish, who asked us the question, says he's 31 years old. So his
Okay.
outlook till he becomes 51 for DMart.
Oh, that's okay. That's okay.
um, we have somebody, Navneet, asking your POV on Tata Motors, but there's one more question from Vimlesh. What do you think of artificial intelligence? And I think a good theme to also talk about is AI, and given what AI is doing right now and the stock markets, do you
I
see it?
don't know about AI in such detail, but what I know is Google is in for a huge shock.
Go on.
And no, but what I'm saying, I don't know AI in such detail. I
Mhm.
just have a broad 30,000 feet view on this. I think Google is in for a huge shock, and people will realize over the next 1 to 3 years how Google didn't do anything with all the advantages that it had. It was the first mover to be doing driverless cars in California, from what I recall. It
Yeah.
did nothing. It's sitting on its cash. Even Apple, for that matter, I mean, people find great value in and great confidence and great encouragement in saying Apple did a buyback of $500 billion. I mean, they should have bought a company like Tesla about 10 years back or made a Tesla of their own. So a company that is doing buyback is a very defensive strategy for me. You should be going out and expanding your business rather than doing buyback. So that's the problem with artificial intelligence. You have to be very good at it and you have to keep moving. You have to keep running. You have to keep pedaling. So I think technology is like cycling. The moment you stop pedaling, you will fall off.
But then
Got it.
maybe they
Thanks
didn't
for
buy
that.
Tesla because
Yash?
Basant, maybe they didn't buy Tesla because they didn't want people to sit in cars. They are now making robots who who can run around like animals. Also, Boston Dynamics. I don't know if you've seen any of their videos. It's pretty
No,
insane, by the way.
no, I know that. I know that. No, no, no. But there's a huge difference in what Tesla is making and what the robots of Boston Dynamics are. There's a huge difference. You should go and see it in much detail. But anyway, this is not a platform for discussing Tesla, so we leave it at that.
Yeah, Basant,
I
Sachin
just
Jain,
also
another one
realized,
of our listeners, has a question on chemical sector. Do you track any of the chemical companies?
Yeah. No, no, I don't track chemicals so much, but they're all in a problem actually. If you see after the
Hmm.
China thing, so that's the thing. But I don't track it so closely for me to be offering any advice that would be helpful to him.
All right. Before we, squeeze in one more question from our listeners, this one's from my end. Basant, a few days or weeks back, we had this data where, uh, you know, almost 89% of FNO traders lose money, something of that sort. Why do you think that is the
Yeah,
reason that,
yeah.
a lot of young traders and investors lose money in markets? And how do you think they can fix it?
I have a question for you. I have a question for you.
Sure.
99% people who go to Las Vegas lose money. Still, people go there. So 99 is still a bigger number than 89. So 89, you've got a better chance than 99, but people do that. I mean, since childhood, I was told that that a cigarette reduces 4 minutes of your life, and things happen. They happen. It's like that. You cannot stop people from trying their luck because when 89% people are losing money, there is another set of 11% people who are making all that those 89 are losing. So negatively, you would think that you are in that 89. But if I'm a positive thinker, I would think I'm a part of that 11, not the 89. So I'm not saying that whether you should trade or not, but I'm saying the human mind normally wants to look at the worst of everything. So why not look at the 11% who are making money? So no encouragement to anyone to trade, but these things will happen. And moral policing doesn't happen in this world. I mean, if people want to lose their money, it's their money. Unless you've picked up your neighbor's wallet and you've run off to your stockbroker's office, then that's another thing. But otherwise, if it's your money, go and lose it up. That's it.
on that note, Basant,
Yeah.
this positively should be one of the most funnest spaces that Yash and I have had the
Thank you
pleasure
so
of
much.
hosting. Thank
Yeah.
you so much once again, and I
Yeah.
must say this is also the most well-attended session. So
Right.
thanks to all of you who have tuned in and sent us your questions. This recording should be active, so if you'd like to listen to Basant all over again, you can always revisit this tweet and listen to the Spaces session. And on behalf of StockTrades India and Business Insider India, we'll be back again next week about the same time. And Basant, we'll hope that we can have you back again in the future as well
Sure.
with more
Thank you so
candid
much.
thoughts.
Yeah.
Thank you, Basant, everyone, for joining. Take care.